All right, we're getting set up here. I think we're streaming live. Took me a second. I had to get some stuff organized. So welcome everybody to our Thursday at 1 p.m. live Eastern time. And Douglas J. Beck here. I'm excited. We have our Growth Collective members and also a couple folks on the funding side joining us for today's conversation. So I'm excited about that and looking forward to taking your questions regarding funding and also talking about some funding mistakes to avoid, as the title infers there. We just came out of our hot seat discussion. We just talked about a deal down in Texas, one of our clients is working on, and they're excited about it. It's a 13-unit building, and they're looking to buy this property. We talked about bridge loans. We talked about DSCR loans. We talked about different factors of what to consider. But we're going to dive a little bit deeper today as well, right? I'm actually honored to have Rich, who works alongside of me inside of the realdirectlending.com team, and also Jay Kister, who's our CEO at KPRA Capital Group here as well. We got some experts alongside of me helping on the funding side. I'm going to introduce them in a second. I like to just take inventory, kind of who's in the Facebook room. I'm going to go ahead and go into Facebook now. And if you are here listening live, or if you catch the replay, just let us know where you're located, what city and state. And if you have any particular questions, go ahead and pop those into Facebook. If you are a member of the Growth Collective, go ahead and come into the Zoom. You should have a link already given to you on your channel on Slack or somewhere on Google on the calendar. If you're not a member of the Growth Collective, go check out jointhegrowthcollective.com and learn all about what that means and what it's about. It's going to help you propel and accelerate towards more closings, whether it's your first closing or your next closing. If you're trying to grow your business or just trying to get started, we have options to consider and how we can help empower and help you grow and close more deals. So with that being said, let me see here. I'm going to pop into the group on the other screen. And I know we've got Cannons here. I see Jay's up top. We got Mo, we got Mikkel, we got Noman. With lots of folks in the room on Zoom, Wendy, Rich, obviously, Joe and Violet down in Texas, Glenn and Jenny. Awesome to have everybody here. Unless you check the broadcast is looking good, I believe. Let me see. We got a handful of folks on. Go ahead and comment, guys. Make sure you're commenting. San Antonio, Texas. We got Michael. So there's another, actually, Joe and Violet, I think, are in San Antonio. So be sure to connect. Michael Murdoch is down in San Antonio, Texas area. So Michael, we have a couple of clients down that way. Love for you to get connected. Who else do we have on Facebook? Anyone else on Facebook? Tell us where you're coming from, where you're based out of. That'd be awesome. Columbus, Ohio. We got Reed from Columbus, Ohio in the room with us as well. Excellent. And I know, do me a favor, guys. I know you're all kind of sitting here listening to me in Zoom, but just go ahead and just play for fun. Put it into the Zoom where you're sitting right now. If you're either in your normal place or you're somewhere else traveling, tell us city and state. I'm just going to rattle off a couple of different city and states where you guys are all at. And then that will get the Facebook folks, kind of geographically where we're covered as far as folks in the room with Zoom on the Growth Collective side. Do me a favor and just go ahead and put that into the chat. And then we'll give everybody a couple of seconds to get settled in, and we'll dive into some conversation around funding. As you guys are doing that, you could tell in the description and the email marketing and the messages you got, pretty much, like it says, when you're just getting started, especially, and you really don't know like who's on your side. There's a lot of stuff going on in the funding with hard money, private money. You really don't know what's happening. You don't know, are you doing the right thing? Are you being kind of naive by accident, not really knowing what's going on? Are you getting charged too much? Is it the right structure? Are you getting the right loan to value, the right loan to cost? Are you getting, the right kind of loan to begin with? Are you maximizing that deal with the kind of loan you're getting? And a lot of folks, they have this perception that, oh, well, hard money is expensive or private money is expensive. And what happens is they'll look for the best rate. A lot of us will look for just the best rate. They don't look at anything else besides rates. And I can tell you that from having borrowed tens of millions of dollars for hard money deals and private money deals, it's not just about the rate, because the rate could be really low. But for example, the rate could be super low because you're getting practically no loan. You might be getting a 60%, 70% LTV or LTC, and you might not even know what that means yet. So we're going to explain some of that today, right? We have a whole training on funding in this group on the top. Okay. If you're watching this set of Facebook and also my Growth Collective members, you guys haven't seen it. We have multiple trainings, I think, inside the guide section. So if you want to get kind of a crash course after today's conversation, if I say some things or Rich or Jay or anyone else says something that doesn't make a whole lot of sense, you're like, what does that even mean? Go into the guides and check out the videos from the Deal Maker Challenge we did at the end of last year. And I believe it's on day 3 or 4, right? That has actual training with actual slides. You can go through one by one and read and listen as I'm talking over those slides, explaining kind of how funding works in this real estate investment business at a basic level. Not a prerequisite to kind of listen to us today, because you're going to still get some value. We're going to talk about some of those terms, but really to kind of level set, kind of get up to par with like the rest of the group and know kind of how things work. It's a good idea to do that. Like I said, a lot of folks will get into those like quote unquote lower interest. A lot of people are doing what's called bait and switch, which is horrible, but they're basically saying, hey, we got this crazy low rate available to you, come talk to us. And then you call them and you start talking. Next thing you know, it's 3% higher than what they said on the email or the thing. We don't like to do that. We don't do that. We tell you straight up what it is. We say, look, here's where you're at based on some information, maybe your level of experience, your credit score, your kind of deal that you have, where it's located, kind of all those different factors. We'll figure out what the pricing looks like. But we're not going to give you that number and then change it up later on. It's going to be pretty much here's what it is. Here's what we could do. And the market is getting more tough. It's getting tougher, I should say. So I want to hear from, maybe Rich and Jay in a little bit here about some of the things they're seeing with the landscape and lending from a pricing perspective and kind of some of the factors that are playing into why things are the way they are. But this is not just about like quote unquote hard money. This is not just about private money. This is also about other types of loan products available. So at KPRE, there's a division that Jay leads up that's on the conventional side that you guys can learn more about if we have some time today. That might make sense for somebody, but usually, we can look at pretty much the other alternatives first. If you're talking about investment property, there's various reasons as to why. And then as it says there, there's things to look out for. You want to make sure you're reading the fine print. Okay. And so we're going to talk about some of the mistakes that people make with mortgages and funding and stuff like that, that kind of really don't help you, right? They kind of hurt you, that are not as obvious sometimes. We're going to talk about some of the pros and the cons of different types of loan products. For example, bridge loans versus fix and flip versus a DSCR rental loan, right? Residential loan products versus commercial loan products. What's the difference there? Those are the kind of things we'll be talking about. So if any of that stuff sounds exciting or something you want to learn more about, then hang out and stay with us. If not, no sweat. I'll say it again, like it's no disrespect, but if you came to this presentation, this meeting for some other reason besides what we're talking about, it's no big deal. We appreciate you being here. You could just kind of, stop the broadcast on your side, exit the group if you need to. We want to make sure we're serving the right people, right? We want to make sure that we have the right people in the right place at the right time. So we're not offended, no sweat. We've had some folks come in and say some different things over the past few weeks. They're like, okay, they're definitely not in the right place. So let's, let's get those folks on the other side over there. All right, you guys can just step out of the way. So, okay, we got candidates in St. Pete, Florida, and we got Glenn and Jenny down in Venice, and my group on Zoom is being kind of quiet. So I know Rich is up in New Jersey. I think he's up in New Jersey, right? And we got Joe and Violet down in San Antonio. So we got folks in different parts of the country. Jay's out where in Arizona, Jay? Yep. And then we got Gloria down in Texas, and we got some folks in other places. Andrew's up in New Jersey, Alicia as well, I believe. Awesome. So is there any particular questions? I'm going to open up to the Growth Collective members first of just a question on funding at whatever level, granular detail or strategic high level that you all have. And I'm going to bring up Rich and Jay for right now to kind of take those questions with me before we get into some any additional stuff we want to talk about. All right. So I'm going to bring Jay up here. Where's Rich at? I saw him there. There he is. All right. Do we have any questions in the group, the Growth Collective group? If you do, just come off a mute. Okay. This is your opportunity to ask funding questions, right? You got three guys here. Jay's been doing this. Jay, why don't you tell us about your background in the meantime? Tell us kind of how we got to this point. What's your career been like in the funding space? What are you doing now?
Right. Well, I've owned several mortgage companies over the last 20 years and been through the ups and downs of the markets. And really since about 2014, been completely focused with the fix and flip, really focused. I mean, that's our real niche in the market is working with fix and flippers. Yeah.
Excellent. So about how long? You said for a little while, like a couple decades or
20
what?
years. Yeah.
20 years.
It's been a while.
Okay. And that's been on the conventional side as well as like the private money side, hard money, or just like what's that blend look like? Just to get an
all
idea.
of the above. So I've had private
above.
mortgage companies. I've had conventional mortgage companies. So I've ran and owned both. Yeah.
Excellent. And then bring us up to speed, like today, like what do you do currently? What's your main focus? Like what you work with us, obviously you're in the fund and you help originate and stuff like that. So tell us about what that looks like today.
Yep. So our main focus right now has been launching KPRE. We've launched a fund, so we're bringing in capital so that we can exponentially grow and serve more fix and flippers at better terms. So that's been our primary focus right now.
Excellent. And then what kind of loan products or what kind of size loans, generally you're looking at, like what's the most common? Is it like 1 to 4 family fix and flip, or what's like the kind of everyday typical stuff you look at?
Yeah, for sure. And The single family has just been, it's just been a rock solid product, right? Especially all the smart flippers that we work with, end of last year when all the news was all bad about how horrible the real estate market's going to be and it's going to tank and all of that stuff. All the smart flipper money was jumping in and buying because there were a
Right.
lot of sellers that were scared by the news and they're dumping their properties. So the smart flippers were jumping in. So we've been, it really seems the worse the news is about real estate coming out, the
Yeah.
busier we get because flippers know. And if you've been through enough real estate cycles, you know, especially going into a recession, that's the primo time to pick up some great deals. So
Excellent.
that's really been their focus. And then, you know, from the lending side, everyone wants to maximize their leverage, right? Get the
Right.
highest loan to cost that you possibly can, the highest LTV to ARV. So we have probably some of the most aggressive that are out in the market right now that will go 85% loan to cost with a 75% loan to ARV. So those are really aggressive.
Excellent. Excellent. Awesome. So Jay, thank you for that. We're going to come back in a little bit, but I want to get Rich an opportunity to kind of introduce himself. Rich, take us through kind of your journey, even before like real estate investing. If you want to share a little bit about that, kind of how you started, what you got into, what you decided to do, what you went from and to, and kind of all
Yeah,
the stuff in
sure.
between. Yeah.
So I was a business owner for 20 something years. Was in the fitness industry, all that kind of stuff. So did a lot of stuff there, had a lot of great success. Decided to get into real estate. A client of mine made a lot of money. I figured I wanted to do that as well. So I started out as an investor. I started out as a student of Doug's, as a matter of fact. And so I was on the other end of those loans. I was the ones applying for them and getting them and stuff. So you know, one thing led to another, started working with you, and then we started getting into the lending side of it. We were working for a private lender, and then, you know, we left there and started, you know, real direct lending. And, you know, of course, I know Phil as well, part of KPRE. So, you know,
Yep.
I've been doing a lot of that as of lately. I am doing a lot more on the rental side of it. I know Jay's doing a lot more of the flips. But I've been doing a lot of, as a matter of fact, I've got to submit a cash out refinance as soon as we're done with this. Probably got to jump off in about 35 minutes. But so a lot of cash out refinances, a lot of purchases, rental properties, you know, things like that. And that market is still strong. I've got a lot of borrowers looking to
Yep.
do that.
Excellent. Yeah. So, and you've got the experience firsthand doing fix and flip, wholesale, buy and hold, like seeing the inside of a fund, on the outside, the perimeter, the landscape of different lenders and stuff like that. So you got a really unique, which is powerful. And like Jay as well, I think has got that hands-on, and Phil as well. So kind of the KPRE group and real direct lending and all the affiliated, you know, fund side of things, we have a lot of real life experience, not just on the lending side, right? There's this perception, I think, that a lot of folks have, and I'm bringing Jay back up here too, that maybe like these lenders, oh, they're just like putting out money. They have no idea what we're really doing. They don't know how this really works. Like, what do they know about fixing and flipping houses? Or what do they know about buying property, renting property, things like that? I'd say for us, you know, pretty confidently, it's quite the opposite, right? It's like we know that from firsthand experience and living it and doing it. So, okay, let's
Well,
see.
and
We got a couple.
that
Jay.
stereotype isn't that stereotype isn't completely unfounded. There are a lot of lenders that just don't have a clue what it takes to
Right.
flip a property. And
Yeah.
when you get in there and you flip a property and you're out there swinging a hammer and then you're getting a renter in there to hold it as rentals, it means a lot because then you know what
Right.
you're talking, not just through the loan, which is, you know, we want to help you get the loan, but we're going to be with you all the way through that process. You're either going to sell it and be right back into another one, or you're going to keep it as a rental and we're going to refinance you out of the fix and flip loan and into a rental loan. And we can help walk you through and the draw processes and all of that.
Right. Exactly. Excellent. So yeah, we got a couple of, thank you, Jay, for that. That's super helpful. And yeah, there's definitely folks that I've talked with over the years that are purely just like capital and like lending people that just don't really get totally real estate stuff, which is tough because, you know, folks listening to us now that have deals or have experience, or maybe you're a contractor or you're a real estate agent or you're someone that knows real estate stuff, but then you go to talk to a lender that supposedly does private money lending or hard money lending. They're like, what do you even mean by that? Like, they're like, well, you know, these questions that they're asking you as a borrower, potential borrower, doesn't even make sense. So we're not going to be like that. You talk to any one of us at KPRE and the group there, so it's going to be pretty familiar to what you're doing, and so we can basically give you some advice and guidance as well in the process. So I'm going to come back to that, but I want to share a couple of questions that we have inside the chat from the Growth Collective, and I'm gonna ask these on behalf of the clients just to kind of make sure we have a certain speed and cadence to the rest of the meeting here. So Jenny and Glenn said, "I've heard it's possible to negotiate points. Is this true? And if so, when can we look at the next deal to make sure we get even better deal than that?" So is it possible to negotiate points, and what would be some of the levers for someone to get better pricing on points? We'll say either one of you guys want to answer that, and I'll give my 2 cents as well.
Yeah, no,
Go ahead.
yeah, no,
Yeah.
I was going to say that there's always room for negotiation, right? But you have to have offsetting parameters to negotiate with, right?
Right.
So, for example, some of those are if you have a lot of experience, the more experience you have with flips, the more you're able to negotiate both rate and points that are better, right?
Right.
So, and you should be, we usually build that into the process anyways, especially, and people don't get this as much, and I see it a lot of flippers, and it's fine, you shop and get the best deals you can, right? But the more you spread yourself out, the less relationships you have. And this is a very small niche industry, and building a relationship with a lender means a lot, right? When I've closed, now we're on our third, fourth deal that we're closed, I don't need as big of a margin. I'm going to price you in because I know I'm going to get more and more deals from you. And hence, then I can squeeze the margins and get you better deals because we know how to work. The process becomes easier. The first one's always the hardest. It's always the most expensive for the lender. And the negotiation, remember, is always within the margin. There's always a cost to capital. So you get to a certain base, you can't get any lower, but
That's really good feedback. And I want to hear from Rich, but I want to just kind of make a comment off what Jay just said there, because I can give you a quick example. So there's a particular lender that I was working with when I was heavily focused on fixing and flipping. And Rich, we were working together on a bunch of stuff during this time, probably 2018, 2019, really going, hard, buying a property or two every month and stuff. And that particular lender was, initially, pretty aggressively priced at that time. The rates were definitely lower than they are today. But the fact was, like Jay just said, the first deal I did, I think I was probably at like 11 or 12 and maybe 2 or 2.5 points. But the last deal I did with them, I got down to, and this was when the market was a little better from a lending landscape. It was like 8.5 and 1.5 or something like that. But it was after 20 plus loans, right? Like we're talking about tens of millions of dollars of borrowed capital and return capital. And it got to a point where like, really it would just be like, hey, send me the contract, send me the scope of work and the budget, and send me 3 comps. And then we'll order like an internal evaluation, almost like a BPO or an AVM, and then we just close in a couple of days later. And that was the rhythm we had because of the experience, because of return of principal. That relationship was built. We borrowed capital, we returned capital. We borrowed capital, return capital. So that transactional back and forth, to Jay's point, makes a big difference for a lender to see that you could actually do those things. You could borrow and pay back, and you have that reliability and do volume. So is that a fair assessment, Jay? Kind of what you're talking about?
For sure.
Yeah. Awesome. Rich, what are some other things you've seen on the points discussion? And just to clarify too, points, I should have said this before, origination points, when these loans, these private commercial loans are originated or made, there's percentage points paid that goes to the lender. That's what we're talking about, everybody. So Rich, you see that being a thing like Jay said, and what we just, anything else you want to add, I should say, really, because I think you've seen the same.
I mean, there are floors to everything, but usually what I ask the borrower too, when someone's coming to a loan, I'm like, what's most important to you? Is it rate? Is it points? Is it loan to value? And then I can kind of structure it, and Jay, you probably do the same thing, kind of structure a little bit. So maybe I'm going to bump up your points. Bump up your rate and get you lower points, or maybe you want a lower rate so I can buy it down. And it's going to cost you an extra point or two. So, I kind of see what's most important to you on those 3 things and see how I can do it as best I can. Right. Now, like you said, there are floors to these things, so I can't do it, for nothing. But there's ways to structure it. So there are options there.
Excellent. Okay, good stuff. We got another question or comment. There's Cannon says she thinks that sometimes people are getting confused between commercial loans, investor loans, DSCR, hard money loans, etc. So maybe just give some clarity on that. Maybe I'll kick us off a little bit on that. So just to clarify, KPRE and through realdirectlending.com, if you guys go through that gateway to kind of get a loan submitted over, and we're going to have that direct connection soon to KPRE so we can actually get that into the process faster. But through any means that KPRE Capital Group is funding a loan, it's going to be a commercial loan unless Jay gets involved and utilizes his licensing that he has in certain states, which he could talk about on the residential side. But I would say 90% of 95, probably what I'm seeing, what we do and what we've been bringing through realdirectlending.com, the website, is to shift over to commercial loans. And really those commercial loans are made to entities. So very important when you're going into contract, if you're looking to do an investment deal, it's best to talk to your counsel, talk to your CPA, right? Your whole situation might be a little different. This is just my experience talking here, what I've seen and what our borrowers do, what we need them to do is you need to have an entity that's going to close on the property. We don't make loans to individuals on the commercial loan side of the things with the fix and flip loans and things like that. Now, Jay could probably comment on like, non-QM or those kind of things or other types of conventional financing. But generally speaking, the largest audience I think we have here and inside this group is going to be looking at those commercial loans coming from a private lending institution like KPRE Capital Group, right? Anything else you guys want to add about that piece of it? That we could talk about like DSCR and like hard money loans versus private money loans, like that kind of distinction. It's not really a big difference, but it is kind of
well, right. Well, I think it does get really confusing because there's so many acronyms and things flown around. But you have two big umbrellas. You have commercial loans, and then you have consumer loans, right? And under your commercial loans is going to be anything that you're closing in the entity. So when we're doing a fix and flip, you're doing a hard money loan, your DCSR. So when and this is kind of where it bridges between and DCSR is basically you're using the rent to qualify for the loan. And that can cross in between the two. So we can either be, it can be the consumer loan or it can be under the commercial umbrella. But either way, that's your 30-year long-term loan. Or you can use your tax returns or bank statements, and we can get a little bit lower, better rates, with those long-term.
Yeah, a lot of people don't know. Sometimes they ask a question, what is like a no doc or low doc compared to a full doc type loan? And that's just it. So where you're doing a full doc loan where you're going to more of a commercial type bank, you're going to be giving tax returns, W-2s. They're going to be going through a lot of your personal stuff, where if we are doing a low doc loan, which is like a DSCR loans that I do mostly, it's very low doc, right? I just need entity information, asset statements, driver's license, a couple other things, and that's it. Now the rate for me is going to be a little bit higher, but I can close faster. And, it's not going to, they're not going to go through your entire life with a fine tooth comb. Either, because it's DSCR based, it's based on the asset itself. So that's the difference between those two. And again, yes, you have to be in an entity and you cannot own or occupy. So those are the two like hard things you have to do. Otherwise we can't do loan.
All right, excellent. And I see we have another person from the KPRE side. I'm gonna bring him up here in a second. Just a quick thought. So Larry's with us as well. And Larry's heading up our sales team and doing some really cool stuff on the bigger commercial stuff too, that I'm learning about, that he's getting involved with, and really cool stuff there. But one more distinction I'll share, and then bring Larry up and kind of give some feedback, maybe introduce himself and kind of talk through some different things here as well. The concept of hard money, right? Hard money, from what I learned, and Jay, you could probably comment on this too, and Larry, I'm sure, and Rich, hard money infers that the asset is hard, right? The hard asset, as in like this real estate, this property, this house, this building. And also, it looks at what I've seen as hard money, like is almost like a DSCR loan, really, because it's like income producing type assets. Usually hard money is made to the asset, and the true hard money, right? True hard money doesn't have a personal guarantee. The way I understand hard money, right? The way historically it was. Now, fast forward to today, or the past decade or so of my experience, and other people have said like, well, hard money lenders are the ones that make the loans for like fix and flip properties, or the ones that, I go and get 80, 85%, that kind of thing. But you have to usually sign a personal guarantee. So some people call that quote unquote soft money, right? Or private money, right? Because there's a personal signature tied to that, meaning that your assets are being at risk, which sounds scary, but it basically means that we're not going to use this speculation of this property bringing in a certain amount of income. It may not have any income. In fact, it might be totally distressed. So we can't really use the property's value so much as we're going to use your value as your credit and your assets and things like that to back up this loan that we're making. So that's kind of just a distinction, I would say. hard money versus like private money. We're more on the private money side, right? There might be a non-recourse product out there that we can work with. That's probably something that Jay or Larry can comment on better than I can. But generally speaking, we're doing recourse loans on these commercial loan, products that are related to fix and flip or DSCR. Is that a fair assessment, guys? I'm gonna bring Larry up too.
It is. And the term hard money has morphed of what it means
Right.
over the years, without a
Yeah.
doubt. And really, and it's kind of used as a catch-all right now. But how we would distinguish it is our hard money guys are the ones that are actually going to cut a check. And they're just like you said, asset-based. They're just looking at the asset and nothing else.
Right.
Your private equity, private money, which we're more focused on. We do have hard money when we need it, right? But the private money is more institutional money that we're getting. We have a fund, and then we're funding that money. And that money is going to be a little bit cheaper than your hard money. So,
Right.
but there's
Exactly.
there's a use and a reason for all of it, and it's not something to be scared of, because you have to look at the deal, the cost and speed of your money, right? Because that's where you make your money. A lot of people get really mired down with the interest rates and points, and it's that old adage, are you gonna step over the dollar to get the dime, right? It's
Right.
it's don't lose the big picture of why you're doing the deal to begin with. So
Right.
and then work
Exactly.
backwards.
Excellent. That's helpful, Jay. Appreciate that. Larry, go ahead and give us a quick intro, man. Appreciate you joining us. I know it's on the fly and you got probably things going on there, but appreciate you
No,
hopping
it's
in
all
here.
good.
So
All right.
tell us
So
about your background and stuff, man. Yeah.
yeah, Larry Clinton, been in lending 30 years. That kind of ages me. So, that's sometimes a bad thing, sometimes a good thing. But bottom line is I've been in all aspects of lending, from single family residence to hard money to commercial. I was on the development side for non-QM with Angel Oak Home Loans in Atlanta out of Buckhead for 5 years, helped start up debt coverage ratio loans that we're talking about today, and bank statement loans and P&L loans and 1099 loans and no doc loans on the single family residence side, which we can use to do takeouts after we do the fix and flip or hard money loans. If you're looking to do a buy and hold or a short-term rental model. So I was involved in all of that. Now I'm with KPRE, and Jay and I have been, I think, together now for about 20 years. And we've been partnered in a lot of transactions. Even when I was working in the direct lending side, I was always go to Jay for my hard money lending needs and my fix and flip needs and commercial needs. Now I've stepped in with KPRE, and I brought some of my commercial contacts over with me, some of my lending platforms out of New York and Los Angeles. And so we're utilizing those on the platform for some of the out of box deals that don't fit into the KPRE platform. So that's a little background on me. I'm in San Clemente, California, and it's cloudy here, and we're about a block from the ocean, and we'd like the sun to come out.
There you go. Love it. I like your signature line has that. It's like a dog surfing, I think, on the water. I noticed that. That was pretty cool, man. I like that. Represents the location pretty well.
Yeah.
Good stuff. So listen, guys, I appreciate you coming in. Just so everyone else knows, this kind of morphed into sort of a panel, which is great. And actually we have the leadership, some of the leadership at KPRE and the team at KPRE, myself and Rich and Jay and Larry here. We're missing Phil. He's busy right now with some other stuff going on. He's actually traveling with some families, things going on. But nonetheless, I want to kind of go into the concept of like the funding mistakes, right? Like what are some things you see borrowers making mistakes about? People coming to you guys with loans. What are you seeing as some of the things, maybe that, scenarios that you see commonly that people are saying, oh, I need a loan for this, and here's where something's off? What do you see a lot of?
For me,
good question. Yeah, so Larry, just real quick, probably one of the bigger rookie mistakes that we're going to see is very, very optimistic guesses on what their after repair value is going to be.
Correct.
Right? So they're looking at comps, but they're looking at the very, very top of what that's going to be, which that may be, and bless you if you get that, but you got to really be a little bit more, you want to be more conservative. And trust me, the lender's going to look at it conservatively. So you want to be conservative. And if those numbers work conservatively and it's better, great. But make sure that you're not super over optimistic or planning market appreciation for that. If you have to, if the only way your deal is profitable is market appreciation, don't touch the deal. It's a bad deal. You're not buying right, right? And I'm
Right.
sure you go over the details of how to buy, but
Jay, you're
that's
talking about like doing almost like you're saying for fix and flip loans, make sure you're forcing the appreciation through value add, through renovations and improvements, right?
correct. Yep, exactly. Mhm.
Okay. Yeah. Once you guys are giving your 2 cents, I'm going to kind of wrap it up with that topic around how to do proper valuation. I'm going to give you guys, everybody is listening, a tool that we like to use that I think that the fund would like to see, something like this or this exact tool to help us understand the underwriting of the deal, how you guys listening to us are going to see your fix and flip project panning out. I'll share with you guys a link in a second, but why don't we go to Larry and then we'll go to Rich and then I'll kind of wrap it around.
I think one of the mistakes that I see made a lot is in itemization and the budget on the build out. Walk through the property, you've got a contractor with you, or you're a contractor and you're walking through the property and you're analyzing flooring and countertops and windows and roofs and, you know, walls being taken out and ducts being moved for air conditioning units and all these things. And your estimate from the standpoint of your contractor to the cost to build and the material cost, those really need to be dialed in, because what happens is we get those itemization of costs, which also determines an ARV when it comes to the as-is appraisal, and the appraiser looking at that cost to build to do his analytics on where those comps fall based on what you're adding or doing to the property. I think that needs to be dialed in really tight. You have to trust your contractor. You got to have not just 2 eyes on that, but maybe 4 to 6 eyes on it. So you can have like a panel or a committee on your own itemization. So you know that you're at least drilled down within a 10 to 15% variance of what material costs might be and labor costs. You know, demo is a major thing. That's usually the first thing that's done on a fix and flip is you got to look at the demo. What's that demo going to cost? How thick is that concrete that I got to jack out and get out of that driveway so I can put a new driveway in or a new deck? You know, we see a lot of 14 to 16-inch concrete when you're really trying to challenge for 12. Well, you get 16-inch concrete in the back of a truck and you go to the dump, now your dump costs are double. So you just got to be careful on your itemization of costs. And that's what I can add to it right now.
I was gonna say that if you guys just heard what Larry just said there, that's like specific. So his experience and Jay's and Rich's and mine hopefully are coming through with our comments. This isn't just like superfluous, high level, fluffy stuff, right? This is like real life experience, seeing loans, seeing deals, seeing projects, hands on, boots on the ground, you know, real life. So awesome to have you guys here. Thank you, Larry, for that. So I'm just going to summarize what I heard you say, like basically scope of work development, budgetary, planning the project out, kind of along the lines of Jay's saying, but more on the renovation side, having the proper plan, right? Having the proper renovation plan and then connecting that to that ARV, making sure we have enough of a correlation of a budget that's accurate and full to get that ARV that we want to get. It's kind of like we can't go for that fixed up ARV if we don't do any work pretty much. We got to have the work that needs to get done and at the granularity it needs to be to get that ARV. That's kind of what you're saying, right?
Yeah, exactly.
Excellent. Good stuff, man. Hey, Rich, what are your thoughts? What are some other things you're seeing? Maybe on a DSCR side would be good too, because they're kind of giving different elements of perspective.
Yeah, right. On the rental side. Well, the biggest thing I fight with everyone all the time is, is credit score. I got people coming to me with a 520, 530 credit score and want to buy an 8 unit with no experience. So I have to put it on mute and laugh a little bit, but
Yeah.
They have a lot of these expectations. So that's one thing. But the biggest issue that I have with rental properties coming to me is what we just did on the hot seat is analyzing a rental property, like fix and flip, right? You get your ARV, you get your construction costs, you can put that in and get what you need. But being able to estimate expenses and what the market rents are and stuff, they have a very hard time doing that. What I've been seeing a lot lately is people want to buy properties and turning them into Airbnbs. And it's a little more difficult these days. Lenders don't really like Airbnbs too much. You have to make sure it's okay to do it in your town. And, I just had one that, the guy bought the property, was going to do a fix and flip and wanted to refinance it into an Airbnb, but it has no Airbnb history, has no rental history. And that's extremely hard to fund. And, you know, we have
Right.
an issue with that. But, you know, it's mostly being able to analyze the deal, making sure the DSCR works good. I have a tool that can do that for them. But you know, again, I need the expenses and stuff, and a lot of people don't realize all the expenses involved in a rental property. You know, we went through it on the hot seat, and I'm constantly doing that with guys in this group here. But being able to analyze that properly, especially with your expenses, a lot of people are missing expenses and not adding things in that should be in, and then all of a sudden you go to do it and your DSCR is below 1. Now I can't, you know, I can't lend to you. So that's
Yeah.
what I see mostly.
Okay. So to kind of
I'd like
summarize
to-
what I'm hearing. Oh, go
I'd
ahead,
like
Larry.
to comment on that DSR just real quick for some information for everybody on the call. And this has just popped up recently. We have some new non-QM lenders that are allowing us to use the short-term rental rents without a 12-month history. And that's been the case in the past. We need a 12-month history. We got to pull the Airbnb's ledgers, look at all the rents and calculate. Now they're letting us go to different rental sites and use whatever the common Airbnb rents are for the area and use those rents and analyze those for calculating the debt coverage ratio, payment schedule, and the rents. So there's a couple out there that will let us do it. And that's a big thing because we were handcuffed before, and now that's opened up a big world for us.
Well, that's good.
Yeah, but
You
also
definitely wanna connect.
note on that, that the expenses, to Rich's point, are a lot more expensive on a short-term rental.
Right.
There's a lot more
Yes.
expenses.
Yeah.
So
You got to use the right
beware.
level of expenses to underwrite the DSCR for the Airbnb. It's a lot of letters and numbers and things we're talking about here, but I hear you guys. So just, I'm going to zoom us out for a second because you guys are
Okay.
all experts in your space and you're my friends and my team members. But so I want to be respectful of the fact that we also have a lot of folks here that don't know all the details, but that's okay. So just to kind of translate a little bit. So what Larry just said, and when Jay's commenting on, and Rich is talking about, is when you're going to buy rental property, right? You could buy rental property with the intention to keep it as a long-term rental, or you could use the property as a short-term rental, depending upon where it's at, the licensing required. Airbnb, I'm pretty sure everybody listening to us has seen or heard Airbnb at some point. If you're going to buy a rental property, historically, like there were loan products that we have available and that our, you know, collaboration partners on those kind of loans have available, which are Airbnb style loans. But with the things happening in the economy, and what Larry's saying is that kind of went away and kind of, you know, we started underwriting deals based on long-term tenancy versus being underwriting, meaning like making the loan based upon the debt coverage, the actual money that's coming in from a long-term rental, even though it was going to be used as an Airbnb. And that what that does, it limits your ability to buy at the price you could buy it at, because these properties a lot of times are beachfront properties or in major areas that people like to travel to. Like they're going to have a certain amount of allure or appreciation, if you would, about the location. That doesn't necessarily bring the highest rent long term, but it would be more like hospitality, like a little hotel, motel kind of ish, like right, boutique kind of. This is a place people stay for a few nights, kind of thing. So you're not going to always pull that income you need to pull to get your coverage, like what Rich is saying, your rental DSCR, debt service coverage. So what Larry just said, though, right, just to kind of translate a little bit to kind of everyone in the group here can understand. We have products now available through our own and through relationships we have that can do Airbnb loans that are using the Airbnb modeling without having history of Airbnb. Okay.
Right.
So that's good because that means that if you have an Airbnb that you're looking to buy, you're looking to refinance, and I'm gonna let Rich, he has to get going to a call here, so I'm gonna let Rich step away for a minute. If you're looking to buy a property that's an Airbnb, is it also refinance, guys? Do you know offhand? Is it refis too?
It is.
Okay. So purchase or refinance Airbnb, and you want to use the benefit of the Airbnb's income, which means you have higher cash flow usually. But to Jay's point, make sure you're checking your expenses. Make sure you're looking at that expense item for what it's going to take to run that Airbnb, right? But if you have that and something looks good, right? Something looks good, like you want to use this model to go and get the loan, we can help you. So the way that you can reach out, you can see the email addresses, Jay at KPRE Capital Group, Larry at KPRE Capital Group, Rich at realdirectlending.com. You guys could send it there. We also have on the website on both realdirectlending.com, which is basically a gateway over to KPRE Capital for first review. You can go there and submit a mini app. You could also go directly to KPRE Capital. So I think Candence, thank you for posting those links. You guys could check those links on Facebook. If you don't know, what I'm saying, or able to type it or something, you can find the link right on Facebook. Okay. Now, what I want to say was back to the analysis conversation. I want to be mindful. We have about, less than 20 minutes, about 15, 20 minutes here of time together that's allocated. We might go a little bit longer, but I don't want to hold these guys up. If they got to go back to doing what they're doing, I can hang with you guys for a few more minutes if needed. But the fact is the analysis, I'm going to give you guys a link. Everybody can use this link. We've talked about this inside of the Facebook group, pretty consistently, right? So it's runyournumbers.com, runyournumbers.com. That link will take you to a free analysis tool that we use inside of our private coaching and mastermind group that basically allows you to model out what some people would call your package, right? Package as in like your marketing package, your analysis package, your deal analysis, right, is all there. It requires you to have some numbers though, but you could run the numbers from what the lender sees, what we would look at as far as this deal either makes sense or it doesn't. And we coach on that inside the Growth Collective. So again, if you want to learn more about the Growth Collective and how that can help you and get direct access to KPRE Capital and the funding programs to be prioritized a certain way, join thegrowthcollective.com. That's going to be your bridge to get there. We have clients sitting here with us now inside the Zoom room talking about this, listening to us, asking questions. They just had a hot seat discussion about a deal right before this conversation. Join thegrowthcollective.com. We'll get you more info. We're bringing you guys the Growth Collective deals through JDL Ventures, the wholesale deals. We're bringing capital through Real Direct Lending and KPRE Capital Group. And we're bringing you experience and coaching. And we're also bringing you connections, which is beautiful. We're getting people to collaborate on deals. Some of our borrowers at KPRE Capital Group actually met each other because of the Growth Collective. They were brought together in a community of people that are now taking on loans and projects together because of the Growth Collective. So that's awesome, right? So it's pretty cool. Join thegrowthcollective.com, but hey, runyournumbers.com for that analysis tool. It's going to show you a nice, very simple, very easy to understand analysis for you and for us to look at. So what I would say is, if you want to get that, higher level priority of a review, and if you're not part of the Growth Collective, then send us the result of what runyournumbers.com looks like. And that's going to be like, oh, this person did the analysis. They have something to show us, to show the financial modeling. They understand how this project might work. And again, some of you here might not know how to do that. So that's a great reason to have a conversation. You go to jointhegrowthcollective.com, set up an appointment with my team or myself, and we'll talk about it. All right. We have a couple more questions here. Let's see. Comment. Yes. So if you guys could please on Facebook, we're kind of quiet on Facebook. We're listening, but we're not participating. And so that's concerning to make sure the feed's working. So if you could just comment, if you're hearing us, put the number 1. It's the easiest thing to do. Press number 1. If you hear me right now and you're here live, press 1. If you hear us on replay, press 2. Okay. It's real simple. 1 for live, 2 for replay. It's really that simple. Press 1. You can do that inside of Zoom too. If you're here live and you're listening and you're still engaged, press 1 on your keyboard, hit enter. It's not hard to do. All right. Excellent. And then we have another question, guys. So some folks are a little bit confused about like points on a mortgage versus the interest and the closing costs. A lot of investors kind of get confused when they see like a closing statement or like the title company says, hey, here's what's looking like. They're like, wait a second, what are all these fees? What's this all about? Can you guys give us some commentary on like kind of what does that look like as far as, the cost to close, like range wise? I know we can't say everybody's gonna have the same numbers. Both of you guys are on mute, by the way, but I'm gonna have you unmute yourselves in a second. Give us some comments like on some of the types of fees or things that would happen on a loan. And if you want to give differences between like, let's say a DSCR loan, if there is differences that you think you should mention, or a regular fix and flip or bridge loan, kind of give us some comments on the cost to close the loan.
I can help.
Yeah.
So on the non-QM platform, which is the debt coverage ratio loans and P&L loans and no docs and some of these loans that are not fix and flip loans, that are not hard money loans, you will see some what's called borrower paid or lender paid. Now, the client's not going to see that. So the client is either going to have to pay points or not pay points. If the client pays points, then the loan amount that the client is requesting for purposes of discussion, we'll use 500,000. 500,000 is a loan amount. If the borrower is going to pay 2 points for that loan, then he would pay $10,000. That would be included in the closing cost. That's not all the closing costs. That's part of the closing cost. If it's an acquisition,
that's paid, just to clarify, that's paid at closing. Because another thing I hear is also, should I pay this lender just to open a file?
Paid at closing. There's no upfront fees. You're going to pay that through the title company or the escrow company, depending on how your state operates. But that would be paid at closing in addition to the title costs, the county recording costs, and your prepaid interests, your impounds, if you're going to impound taxes and insurance, all the fees would be in addition to your points. So if it's 1 point, it's 5,000. It's 2 points, it's 10,000. That's a classic example for a $500,000 loan. If it's 0 points, the rate's normally higher. The rate's normally higher for 0 points. It's baked into the rate, and you wouldn't have any origination or points on a non-QM debt coverage ratio loan. You may have a processing fee or an underwriting fee or an application fee. Normally those run anywhere from $1,200 to $1,700. And you would see that in the lender fees for one that's 0 points. I think
Right.
Rich would probably agree with that.
Would you say most commonly, Larry, is most commonly though, we're seeing when we do loans, like folks are willing to pay the points to have a lower rate, I think is what
That
I've
is
seen
correct,
most of the time.
especially in this climate. And then there's discount points. Discount points are in addition to the origination points. The discount points are used to buy the rate down. So if you have a standard rate with 2 points, $10,000, you might have a rate that's a half a point lower for $15,000 by adding 1 point for the discount points. And that
Right.
would be in addition to, again, the escrow and title fees that would be for your state.
So what
On
you're
hard
saying
money-
basically, I'm sorry, in a general sense, and you could definitely comment on that, the hard money part of it, the private money part, but just in general, I think for folks listening again, because a lot of what you're saying is very detailed, it's very helpful, but just in a general sense, it sounds like there's some flexibility of how we structure those loans to make sure the borrower is satisfied with either paying more upfront and having a lower rate or paying more as a rate and not paying as much upfront. Is that what you're,
We
and
give them
upfront as in
choices.
closing upfront, not like to start the loan process?
We give them choices in the beginning, and when we're going to talk about interest rate with them, we talk about, okay, you can pay X and B, you can get a lower rate, and you can even buy it down with X, or you can pay Y and get a higher rate and save yourself some cash. It just depends on what you want to do as a consumer and your benefits and how you want to debt service your property.
And that's on the debt service coverage and the non-QM.
That is correct.
All right.
Yeah.
Jay, you want to jump in?
And
Go ahead.
how you'd separate that is you're going to have more flexibility with rate versus points on a long-term loan, 30-year fixed loan. We're doing a 12-month loan. There's no room to play. It's just, it is what it is.
Yeah.
It's set. And the reason that you might want to pay those discount points, and this is what will help you analyze, is what is your break-even point? Because if I pay points for a lower interest rate, that monthly savings, when does it break even and I've made all my money back and then I'm in the green after that? So you have to look at how far in the future your break-even point is. And if it's 2 or 3 years and you know you're going to have that property for the next 30 years, then yeah, you want to buy the rate down, right? But if you're like, I'm going to have this rental for 3-5 years, then it may not make sense to buy any rate down and just keep your cash in your bank account and take a higher rate.
Excellent. Okay, good.
I
So then,
I sell the higher rate in this market mainly because I know the rates are destined to fall. And so I'm going to refinance my clients. I'm going to give them the higher rate right now. I'm not going to have them pay discounts if they can debt service and if they can qualify with it. And then I'm going to take them out of the loan and give them some discounts on the second loan once the rates fall. That way I keep my client trusts me and we get more business.
excellent. All right. And again, that goes back to experience. Like we're talking to two guys here that lead the ship on the funding side for KPRE that have decades of experience. So that's really exciting and powerful for people to know. All right. Let's see what other stuff we got here. What other questions we have? What about as far as like, the mortgage that maybe you kind of talked about this a little bit, but traditional mortgages and non-QM and that kind of thing, like conventional, non-QM, like give some clarity on like, what's the qualification? You kind of touched upon that. I forget who did, if it was Jay or Larry, but full doc, low doc, no doc. Rich is back here too. So Rich, you want me to bring you up and talk about that as well a little bit?
Yep.
Yeah. So
I'm going to let Larry and
full.
Rich.
Okay.
I'm going to let Larry and Rich take that. I got to jump on a call with some bankers.
No sweat.
So
Got it, man.
I'll be talking to you.
Appreciate you being here.
Thanks,
Thanks, Jay.
Thanks, Jay. Thanks, Jay. We'll talk.
So
Excellent.
I mostly do low doc loans, which are, again, the thing with that is speed. We can get it closed quickly once we get appraisal and title back. All I need is basically photo ID, LLC docs, offset statements, and one or two other small things, and that's it. I get the whole package once I get it. Once I get the appraisal back, at that point, I can usually lock in your rate. I know you talk about the bait and switch, but I tell the borrowers up front, until I can lock you in, there may be a rate increase. I hopefully not, but that's why we try to do this with speed. So as soon as I get a loan in, we're good to go. They sign the credit authorization, everything. We pull credit looks good. We get that appraisal order immediately. I collect the docs. As soon as appraisal's back, I submit the loan. And that should all take, less than 10 days. And then, we submit into underwriting, we meet the conditions, and we close. So we can typically close a low doc loan in 3 weeks, maybe 2, as composed to a full doc loan, which your rates might be a little bit better, but it's going to take longer, and they're going to require a lot more documents. Personally.
Okay.
So I
Go ahead, Larry.
do a paper is a mixed bag. You got to have the right platform. You got
Larry,
to
a paper is like second nature for you. What does that mean, like in real terms for people that don't?
Yeah,
It's all right.
sorry. Yeah, that's a full doc. That's tax returns, pay stubs, W-2s, 2 months bank statements. So, and it's run by a desktop underwriting. It's run by what they call AUS, which is automating underwriting services. It's run by Fannie Mae, Freddie, which are major players in the A paper conforming and non-conforming market. Conforming meaning loans that are less than 700, let's say, for purposes of discussion. Non-conforming is a jumbo market, meaning $1 million loans and above.
Okay.
Full doc means 2 years. It's a 2-2-2 rule. You got to have 2 years of employment, 2 years of residency, whether that's rental or ownership. And you've got to have, I like 2 months bank statements. I use that as my 2-2-2 rule. So bottom line is I need 2 years tax returns. I need 2 years residency, a proof of rent or proof of ownership, good mortgage history. These are all things that are part of an A paper underwrite. They take longer. They do take longer. You're governed by an underwriting process. You're governed by regulatory process on disclosure. What you've got going is you've got to prove everything and substantiate everything. So the underwrite is a little longer. And in a perfect world right now, with really quick speed and the right platform, you can close a paper full doc loan with tax returns and everything. I like to say 21 being the quickest. If I close it under 21, then I'm under promising and I'm over delivering. And my average right now, I'm above average. I close A paper loans in 14 days, but it takes, you have to be really on your game to do that. Most guys are going to run them in 30 to 45 days. They're not going to have the control of the underwriter like I have. They're not going to have the same tools that I have to do that. So,
Excellent.
And that's, yeah.
So and on that note, I guess just something that's in the works. I know, and I'll keep it kind of generic because remember we're in a group. There's a small group here in Zoom.
Exactly.
There's a small group in Zoom. This is client group for our growth collective, but then there's a bigger group of like almost 4,000 people that could see this that's recorded too. So just we want to make sure we keep our stuff generic to some extent. But I'm gonna say we just had a recent conversation with an individual, right? That's a CEO of a pretty large mortgage company that we're looking at giving some business to on the conventional side. And it sounds like there might even be some more efficiency beyond what you just said, beyond like in some relation to that. So where can we originate as a group or as Larry, those conventional loans right now? Where are we licensed to set up and help people? If someone's listening to us right now, where can we help them as far as regular A paper?
So we're in 48 states, and probably have the ability to go to 50. We have to be licensed individually in the state to do business there. However, we have a multitude of agents under the KPR platform that are licensed. Like I'm licensed in 7 states. I have an agent that's licensed in 15. So we're
Okay.
licensed in pretty much every state to do business with.
So if somebody has an A paper, otherwise a conventional loan they want to get done, they can just email you, Larry at KPRE Capital Group, and then you can kind of take it from there.
That is correct.
Excellent. And if somebody has a DSCR loan, maybe pass it to Rich first, and Rich can be in touch
Yeah.
with Larry about a quick review. And then obviously Jay's looking at deals. Larry will look at those fix and flip. Rich can look at them. So you guys, you have multiple gentlemen here, right, that can help you. We have a staff of men and women, right, working every day on this stuff with us. And so excited to have you guys here with us. We're going to kind of round it up here, wind it down. What are you going to say? Any final thoughts around, like, capital funding, words of wisdom, takeaways, next steps, whatever you want to share with the group? Maybe start with Rich. We'll come back to Larry, and then I'll wrap it up for us.
Yeah, really, really quick. Again, if you're interested in getting something funded, reach out to one of us, whether it's Larry or me. Even if you have questions, I'm more than happy to help. And if you need something that needs to be priced out, I can do it pretty quickly for you. My caveat to all you people that are listening out there, just be careful, because I know a lot of you guys shop around, you look for stuff, and I'm on social media quite a bit. There are a lot of scammers out there and people that are, not legit, and you have to be very careful. I know a lot of guys that lost money, or, with the old bait and switch and stuff. So if someone's telling you they're going to do 100% funding with no experience, no credit score, I would probably
4% for 50 years or something like that. How about that
I've
one?
seen it online and it looks great, but make sure you vet everybody out. And all I can tell you is that Larry and me and Doug, we're the real deal. We can really fund these things for you. So, and again, we want to establish relationships, because if you fund the more deals you fund with us, the more comfortable we are with you, the better rates we can get you, the better terms. It's easier for me to get exceptions for certain things here and there if you're a borrower with us for a long period of time. So that's the benefit as to just shopping around. We're going to be as competitive as everybody out there in the mainstream business, in the mainstream lending business. So, definitely reach out to us first, and let's see if we can help you.
Excellent. Larry, before you jump in, I want to say there's one of our clients is actually based in Canada. Wendy's up in Canada. I'm not sure if we can, but that might be the one area we can't help right now. But is there some possibility we could ever help in Canada?
Yes, we've got some lending capabilities in Canada. One of my contractors is a hockey player from Canada. So
okay.
Yeah, so we can make some moves up there. I would just
Wendy, shoot Larry an email. Yeah. Okay. Wait.
Hey, I want to just
mirror
what Rich said. I think that was really good stuff. And there's so much on the A paper side or the full doc side that, we could elaborate on. That's a big deal right there. There's lots of stuff to talk about. But on the fix and flip side, it's really exciting times right now. And with the market the way it is and the rates up on the conforming side and non-conforming side, fix and flip is very attractive, and it can build your business. And I think this platform is great for that. And I think KPRE has a great platform to help. I think Rich's platform, I like what I heard today with Rich. I'm going to reach out to him today too. I'm very visible. I'm on LinkedIn. I'm on Facebook. I'm on Instagram. My wife hates it because I'm always on it, but yeah. So If you need any help, just reach out and we're happy to help you.
Excellent. Appreciate you guys being here. And just my final thoughts are just, you heard everybody talk through different things today. And really the commonality is just like, really know your deal, know your numbers, right? And if you don't know them, that's okay. That's where we can help at the Growth Collective. Literally, all you have to do is go to jointhegrowthcollective.com. You can have more discussion like this, but about your specific deal, right? We have a way that we can actually help you do a deal review, right? In 15 minutes, we'll do a deal review live with you. If you want that, just go to jointhegrowthcollective.com, set up an appointment, talk to our staff, and then go ahead and set up that 15-minute deal review session, and we'll help you. And we'll tell you if the deal is something that we can help fund, or if it's not something we can help fund, and we'll tell you why. We'll show you using the same tool I said before, runyournumbers.com. Runyournumbers.com, it's a free service, but we help you understand how to use it, right? We use that every single day in our coaching and mastermind group, and we go through our clients, our paid clients, to show them how to use that tool and bring those deals over to KPRE Capital Group and help get those deals funded and actually help connect and collaborate with other individuals in the group. So if anything like that sounds interesting, if you got value from today, just imagine what it's like to have 4 or 5 of these sessions every single week, working with myself, working with Larry, working with Rich, working with Jay and Phil and everyone else in the Growth Collective, helping you get deals closed. So with that being said, join thegrowthcollective.com. You're not going to regret it. I'm excited for you guys, and I'll talk to y'all real soon. God bless.
Thanks, Doug.
Thanks, Doug, so much.
Great
Thanks,
day.
everybody.